Here's the truth the headlines are terrified to tell you. While retail investors were panic selling at the absolute bottom, paralyzed by fear, institutions quietly moved $4 trillion back into metals in less than 48 hours. $4 trillion. Silver didn't just bounce, it ripped 20% higher from its lows. Gold recovered 11% in a heartbeat. And you need to understand something very clearly. The entities accumulating silver at $79 were not the same people who dumped it at $120. The hands changed. The power shifted. This was not a market correction. This was a coordinated, ruthlessly executed wealth transfer. If you're still sitting there trying to figure out if this was a bottom or just another fake out, stop. You are asking the wrong question. The question you should be asking, the question that keeps the bankers up at night, is this. Why did the vaults drain another 2.8% in a single day while the paper price was collapsing? Think about that. Price goes down, inventory disappears. That is not how markets work. That is how raids work. Why were dealers in Singapore facing lines out the door, forming queues to buy physical gold on Monday morning after Friday's absolute bloodbath? And why is China's official government policy now openly stating that gold pricing power equals a strong currency, while they simultaneously buy 10 times more metal than they are reporting to the international community? This isn't speculation. This isn't a conspiracy theory. This is documented, cold, hard fact. And by the time I walk you through exactly what happened between last Thursday and today, you are going to understand the terrifying reality. The forced liquidation you just witnessed wasn't the end of the bull market. It was the confirmation that the game between paper promises and physical reality has entered its final, most dangerous phase. More importantly, you are going to see why the smart money, the people who bought your metal at $79 while you were selling, are positioned for a move that will reshape the global financial system. Because what comes after a $4 trillion reversal in 30 hours isn't stability, it is acceleration. Let's dissect the anatomy of the crash, because the price action tells a completely different story than the lies being sold to retail investors. Silver hit a euphoric $121 on Thursday. By Monday, the floor had fallen out, crashing all the way to $72.80. That is a 40% decline in 3 trading sessions. It was the largest single-day drop since 1980. Gold plummeted from $5,600 to $4,170. It was brutal. It was visceral. It was designed to hurt. But here is what separates normal market volatility from engineered liquidation. The entities selling were not the entities buying. When silver collapsed on Friday, look at the volume. Trading volume on SLV, the largest silver-backed exchange-traded fund, hit 41 billion. Let me repeat that so it sinks in. 41 billion. That is not a misprint. That was the highest volume of any single traded asset in the entire world that day. Not Apple, not Tesla, not Nvidia, a silver ETF. And the media expects you to believe that was organic? They want you to believe that mom-and-pop investors suddenly woke up in unison and decided to dump $41 billion worth of positions all at once? No. That is institutional. That is algorithmic. That is the paper market creating a forced liquidation event through margin calls, stop-loss hunting, and coordinated contract dumps designed to break your will. And while that carnage was happening on the digital screens, something completely different, something contradictory, was unfolding in the real world. Dealers weren't lowering premiums to attract buyers. They were raising them. Buyers weren't disappearing into the shadows. They were lining up in the streets. In Singapore, at United Overseas Bank, the only bank in the country offering direct physical gold, retail investors crowded the lobby on Monday. They weren't there to panic sell. They were there to buy the dip. Despite prices plummeting on the chart, individual buyers were aggressively adding to their positions. Why? Because they understood what the paper market was trying to hide. This wasn't real price discovery. This was a fire sale created by leverage unwinding, and here's the part that should make you sit up and take notice. Physical premiums didn't compress during the crash. They spiked. Economics 101 tells us that when an asset drops 40% in 3 days, premiums should collapse. Sellers should be flooding the market trying to unload inventory at any price. But that didn't happen. Premiums held firm. In some cases, they widened. This means the people holding physical silver looked at $70 on their screens, looked at the metal in their hands, and said no. They didn't panic, they didn't fold, they accumulated. Now ask yourself, what does it mean when the paper price crashes 40%, but physical buyers treat it as the opportunity of a lifetime? It means the control mechanism between paper pricing and physical demand is fracturing. It means the COMEX quote is becoming less and less relevant to actual metal transactions. It means the gap between what silver costs on a screen and what it costs to actually own it is widening at an accelerating rate. But let me show you where this gets even more revealing. because the recovery tells you who was really in control. From the absolute bottom on Monday to where we sit right now, silver has clawed its way back above $85. That is a recovery of over $12 from the lows. Gold has surged back above 4,999. The $4 trillion that evaporated from the market, 35% of it has already returned in just 30 hours. You do not recover $4 trillion in 30 hours through retail buying. Retail does not have that kind of firepower. Retail doesn't move that kind of capital that fast. What you are watching is institutional accumulation. Sovereign wealth funds, central banks, the whales, the same entities that have the infrastructure to dump contracts and trigger cascades also have the infrastructure to catch the falling knife at the bottom without moving the market, until they are already fully positioned. And here is the smoking gun that proves it was coordinated. Open interest on the COMEX barely moved. When silver crashed from $120 to $72, you would expect massive position liquidation. You'd expect open interest to collapse as contracts got closed out in a panic, but it only dropped by a measly 5,000 to 6,000 contracts, from 148,000 down to 142,000. Compare that to 2011, during the Reddit-driven squeeze attempt, when open interest was north of 250,000 contracts. This wasn't retail getting flushed out. Retail had already left the building. This was leveraged speculators getting margin called while institutions stepped in and absorbed the supply at deeply discounted levels. The weak hands got shaken out, the strong hands got stronger, and now you are watching the snapback as those positions get repriced in real time. Let me drill into the mechanics of how this actually unfolded, because understanding the execution reveals the intent. The crash started with a catalyst. It always does. On Thursday, news broke that President Trump had nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is viewed as a hawk. The markets interpreted this as a signal toward tighter monetary policy, higher rates, a stronger dollar. And historically, a stronger dollar puts pressure on commodities priced in dollars. But here's what doesn't add up. The magnitude of the move. A Fed chair nomination does not justify a 40% collapse in silver. It doesn't justify the largest single-day drop since 1980. What it justifies is a 5% pullback, maybe 10% if sentiment is incredibly fragile, but 40%? That only happens when the catalyst is used as cover for something much larger, and that something is forced liquidation. In the days leading up to Thursday, silver had been behaving in a way that created vulnerability. It had run from $50 to $121 in a matter of weeks. Leverage had piled into the market. Open interest had climbed. Every leveraged long position that entered above $90 was sitting on a margin requirement, just waiting to be triggered. So when Warsh got nominated, the entities with the ability to move the market saw an opportunity. They didn't just sell, they dumped. Thousands of contracts hit the futures market in compressed time windows, specifically designed to break technical support levels. Once those levels broke, the algorithms kicked in. Stop losses cascaded like dominoes. And once the momentum started, it fed on itself. Leveraged longs got margin calls. Brokers liquidated positions without asking. Forced selling created more downward pressure. And by the time the dust settled, billions of dollars in paper wealth had been vaporized. But here is the genius of the operation. The entities that triggered the cascade didn't cover at the bottom. They let the price recover. This tells you this wasn't about profit trading. It wasn't about closing short positions at favorable levels. It was about breaking momentum. It was about resetting sentiment. And it was about making sure that anyone who thought silver was going to run to $150 got destroyed before that narrative could take hold. Now let's look beneath the surface, because the physical market was screaming a warning while this was playing out. Vaults drained 2.8% in a single day. That is not a small move. That is massive. That is metal leaving the system at an accelerating rate, and it is happening while the paper price is collapsing. Think about the insanity of that. If the crash were real, if it reflected genuine oversupply or collapsing demand, vaults would be filling up. Sellers would be delivering metal to the exchange. Inventory would be rising. But the exact opposite is happening. Inventory is falling, which means the people holding physical silver aren't convinced by the paper price. They are ignoring it, and it's not just the vaults. Dealers are running out of product. Look at Bullion Star, a major Singapore-based dealer. They are down to one 1,000-ounce bar left in pre-sale inventory. One bar. That is the size industrial buyers need. And after that bar is gone, they are sold out. So while the COMEX is claiming silver is worth $72, industrial users are scrambling to lock in supply because they know the paper price is temporary, but the physical shortage is structural. Now, add the geopolitical layer to this picture, because this is where it becomes a matter of national security. China just released an official government article by Xi Jinping outlining the country's financial strategy. The title? Building a Financial Power. And the top priority listed as task number 1 is achieving a strong currency. How do you achieve a strong currency according to the article? You gain pricing power of gold. You become the number 1 producer, the number 1 consumer, and the number 1 importer. You possess the world's largest reserves. This isn't a think tank report. This isn't some analyst speculating on Twitter. This is official Chinese government policy, published on the central government's website for the world to see. The article explicitly states that China is close to completing preparation and that the global gold final battle is about to break out. Let that sink in for a moment. The second largest economy in the world just told you they are positioning for a gold-based currency war. And they are doing it while accumulating 10 times more metal than they are officially reporting. In November, China bought 10 tons of gold, officially. But in reality, in September, they acquired 15 tons while officially reporting negligible amounts. They are accumulating in secret, publishing minimal numbers to avoid driving prices higher before they are fully positioned. When they finally reveal their actual reserves, when they show the world they hold 10 or 20 times more gold than anyone thought possible, the entire metals market will reprice instantly. Every central bank on the planet will rush to catch up, and the gap between paper pricing and physical reality will become impossible to ignore. But here is where the plot thickens. While China is accumulating gold in the dark, the United States just announced its own critical mineral stockpile. President Trump unveiled a $12 billion program to secure critical metals, including silver, $10 billion in funding from the U.S. Export-Import Bank, $1.67 billion in private capital, with the explicit goal to counter China's dominance in the supply chain. Translation: the U.S. government just admitted that access to physical metal is a national security issue. They are not stockpiling paper contracts. They are stockpiling physical inventory because they know what China knows. Whoever controls the metal controls the pricing, and whoever controls the pricing controls the currency. So now you have two superpowers racing to accumulate physical metal, while the paper market creates the illusion of oversupply. Think about the asymmetry of that dynamic. China buying 10 times reported amounts. The U.S. launching a $12 billion stockpile. Vaults draining, dealers selling out. And yet, the COMEX says silver is worth $85. Does that price reflect reality, or does it reflect what the paper market needs you to believe so institutional buyers can keep accumulating without competition? Now, I need to address the risks because there are real headwinds, and ignoring them would be dishonest. Japan's 30-year bond yield just hit the highest level since those bonds were created. Japan's debt-to-GDP ratio is 250%, the worst of any major economy. The U.S. is at 120%. Japan holds $1,022 trillion in U.S. Treasury debt, more than any other foreign country. For 3 decades, Japanese investors have been running the carry trade. Borrow in Japan at 0%, send the money to the U.S., buy treasuries paying 4 or 5%, and pocket the spread. Free money. But now, Japanese bonds are yielding 3.7%. The spread has collapsed. The free money party is over. And when Japanese investors stop buying U.S. debt, or worse, start selling, Treasury yields spike. When yields spike, everything leveraged against those rates comes under pressure. Stocks, bonds, commodities. That is what triggered the initial metals crash. It wasn't fundamentals. It wasn't oversupply. It was forced liquidation as margin calls spread across the system because the carry trade unwound. The US dollar got dumped at the fastest pace in 2 years. The 10-year Treasury yield approached its highest level since August. The Treasury Secretary was literally calling Japan, begging them to calm the markets, while the Fed stepped in to prop up the yen. This is systemic stress. This is what happens when debt levels become unsustainable and interest rate differentials invert. It is real, and it isn't going away. Japan's debt crisis is real. The carry trade unwind is real. The pressure on global liquidity is real. But here's the twist. That pressure is exactly why metals bounced $4 trillion in 30 hours. Because when systemic stress hits, capital doesn't just vanish, it relocates. And where does it go when currencies are being debased? Where does it go when central banks are trapped between inflation and recession? Where does it go when government debt is spiraling out of control? It goes to the only assets without counterparty risk: gold, silver, physical commodities that cannot be printed, cannot be debased, and cannot default. China understands this. That's why they're accumulating in secret. The U.S. government understands this. That's why they're building a stockpile, and institutional buyers understand this. That's why they moved $4 trillion back into metals in 30 hours while retail was panic selling at the bottom. Let me show you what this means for anyone holding physical metal right now. The gap between paper and physical isn't just wide, it is accelerating. Shanghai silver futures are trading at 112. The Western spot price is at $88. That is a $14 premium. A 20% difference. Even after a 40% crash and a 20% bounce, that premium remains elevated. What does that tell you? It tells you that Chinese buyers are willing to pay 20% more than Western paper pricing. Why? Because they are buying physical delivery, not paper promises. The price of getting actual metal into your hand in China is completely disconnected from what the futures market says it should cost. Think about what happens when that premium keeps widening, when Shanghai hits $130 and the COMEX is still quoting $90, when industrial users in Asia are paying 30% or 40% premiums, while Western investors are still watching the spot price. At some point, the arbitrage becomes too obvious. Buyers stop using the COMEX price as a reference. They start negotiating based on regional physical markets. And when that happens, the paper price loses credibility entirely. We are closer to that moment than we have ever been. Every crash, like Friday's, teaches physical buyers the same lesson. Ignore the paper, stack the metal, and every recovery, like the one we just saw, proves that the underlying bid never left. The only thing that changed was the number on the screen. The fundamentals, deficit supply, industrial demand, sovereign accumulation, didn't budge an inch. Here is the practical reality. If you are holding physical silver and you watched it drop from $120 to $72s, you didn't lose anything, unless you sold. The metal in your safe didn't evaporate. Its utility didn't disappear. The only thing that changed was what some algorithm was willing to pay for a derivative contract on a futures exchange. But if you were leveraged, if you were trading on margin, if you were trying to time the market, you got liquidated, you got shaken out, you lost. Because the game is designed to destroy traders and reward holders. It is designed to punish anyone trying to outsmart the manipulation and reward anyone who has the discipline to just stack metal and wait. Friday's crash proved that. $4 trillion evaporated. Leverage positions got wiped out. Retail panic sold at the bottom, and institutions bought every ounce they could at 79. That is not a coincidence. That is the system working exactly as designed. The weak hands got flushed. The strong hands got stronger. And now the next leg is setting up. So what happens next? There are only two possible outcomes, and both of them end the same way. Scenario 1. The paper market reasserts control. Silver gets capped every time it tries to break above $95 or $100. They trigger another cascade. They force another round of liquidation. They keep the price range bound for another cycle. What does that mean? It means the physical deficit gets worse, vaults keep draining, premiums keep climbing, industrial users get more desperate, and the eventual breakout becomes even more violent because every day that passes with silver in a structural deficit is another day of supply destruction. You cannot reverse consumption. Solar panel manufacturers aren't speculating on prices. They are building factories based on 10-year demand projections. Electronics producers aren't watching charts. They are securing supply chains for products that won't ship until next quarter. When those users see a 40% price drop, they don't see falling demand. They see a discount on the most critical input in their supply chain. So they accelerate orders, they lock in forward contracts, they do whatever it takes to guarantee delivery because they know that if the paper market stays disconnected from physical reality much longer, the premiums are going to explode. A study published in January projected that global silver demand will surge to 48,000 to 54,000 tons annually by 2030. Supply is expected to rise only to 34,000 tons. That means just 62% to 70% of demand will be met through mining. The rest has to come from above-ground inventory, and above-ground inventory is being consumed faster than it is being replaced. The solar sector alone is forecast to consume up to 14,000 tons per year by 2030. That is up to 41% of global supply going into one industry. And here's the kicker. Solar panels don't get recycled easily. That silver is gone permanently. So every month that passes with silver in deficit is a month where the available supply shrinks. The paper market can manipulate prices all it wants, but it cannot change the physics of consumption exceeding production. Deficits don't resolve through suppression. They resolve through price discovery. Real price discovery. Scenario 2. The breakout happens now. Silver retests $100, breaks through, and keeps climbing. The paper market tries to dump it again, but this time physical demand absorbs every single contract. Premiums spike to levels that can't be ignored, and the COMEX starts struggling to make deliveries because inventory has been drained dry. What does that mean? It means the endgame accelerates. It means 3-digit silver this year, not next. And it means anyone without physical metal gets priced out permanently. March is approaching. That is a delivery month on the COMEX. Registered inventory, the metal actually available for delivery, has been depleted. When contract holders stand for delivery and there isn't enough metal to satisfy obligations, the exchange will either raise margin requirements to discourage delivery, or premiums will explode to levels that make it economically impossible for short sellers to source metal. We've already seen hints of this. Physical premiums held during the crash, dealers raised prices, institutional buyers absorbed every dip. Now imagine what happens when March delivery obligations hit and there aren't enough registered ounces to fulfill the contracts. The scramble for physical will overwhelm the paper pricing mechanism entirely, and once that happens, the COMEX quote becomes irrelevant. The only price that matters is the price you can actually secure metal at. Both scenarios resolve the same way. The only variable is timing, and if you are waiting for clarity, if you are waiting for confirmation, you are going to miss it. Because by the time it is obvious to everyone, the metal will be gone. Look at the regional markets. The disconnect is playing out in real time. In Shanghai, silver is $112. In the West, it's $88. In Singapore, retail investors are queuing at banks. At Bullion Star, they are down to 1 bar. While the COMEX is pricing silver at $85, industrial buyers in Asia are scrambling to secure supply because they know the window is closing. They aren't waiting for the perfect entry. They aren't trying to time the bottom. They are buying whatever they can get because they know that in 6 months, metal might not be available at any price. This is what a market fracture looks like. Paper says one thing, physical says another, and the gap widens with every cycle. Eventually, that gap becomes impossible to maintain. Either the paper price adjusts higher to reflect physical reality, or the physical market decouples entirely, and the COMEX quote becomes a historical curiosity that nobody uses anymore. And the entities with the most to lose from that decoupling, they are the same ones engineering these crashes, the bullion banks, the institutions with massive short positions. They know what happens if physical breaks free. They lose control, they lose pricing power, and they are left holding worthless paper contracts while everyone else holds the metal. That is why they are fighting so hard. That is why they are willing to crash silver 40% in 3 days. Because the alternative, letting physical demand overwhelm paper supply, is existential for them. Once you lose pricing power, you lose everything. So this leaves you with a choice. Are you going to treat Friday's crash as evidence that silver is broken, or are you going to recognize it for what it was, a forced liquidation that created a massive buying opportunity for the elites? The data is unambiguous. $4 trillion recovered in 30 hours. Vaults drained 2.8% in 1 day. China buying 10 times reported amounts. Xi Jinping publishing official policy stating gold pricing power equals strong currency. The US government launching a $12 billion metal stockpile. Singapore buyers queuing for physical, dealers sold out of industrial bars, premiums elevated despite a 40% crash. All of that happened while the paper price was collapsing. The entities moving real capital, the ones shifting trillions in 30 hours, are not convinced by the COMEX quote. They are ignoring it. They are stacking physical, and they are positioning for the moment when the gap between paper and reality becomes too wide to bridge. That moment is coming. Maybe it's March, when delivery obligations hit. Maybe it's when China reveals their true reserves. Maybe it's when industrial users bid premiums so high the spot price becomes a joke. I don't know the exact trigger, but I know the direction. And I know that the people who bought at $79 while everyone else was selling are going to be the winners of the next decade. Here's my final point. Stop watching the price. Stop checking every tick. Stop trying to time the bottom or catch the top. The entities controlling the paper market don't care about your chart patterns. They don't care about your technical analysis. They care about control. And they will crash the market 26% in a day if that's what it takes to shake out the weak hands and reset the board. But they cannot change the physical reality. They cannot print silver. They cannot reverse industrial consumption. And they cannot stop sovereign buyers from accumulating. Every crash is temporary, every manipulation has a shelf life, and every forced liquidation creates the setup for the next explosive leg higher. Friday's crash wasn't the end of the silver story. It was confirmation that the story is real. The paper market just showed you it is willing to destroy 40% of value in 3 days to maintain the illusion of control. That should tell you everything you need to know about how desperate they are. They aren't scared of silver at 85. They are scared of silver at $150. They are scared of silver at $200. They are scared of the moment when physical premiums explode so high that the COMEX price becomes irrelevant. $4 trillion recovered in 30 hours. While retail was selling, institutions were buying. While the paper market was collapsing, vaults were draining. And while the headlines were screaming panic, China was accumulating 10 times reported amounts in preparation for the global gold final battle. The crash was the signal. The only question is, did you read it correctly?